Hi guys, welcome to Plain Savers Money Talks episode 7 with Quilter, and we've got Darren with us today from Quilter as one of their financial advisors. And in a minute, he's going to give you a presentation on financial planning. So when you're ready,
Okay,
Darren, please go
thanks
ahead.
very
I
much.
give you the floor.
Thanks a lot. Okay, well, I'm Darren Wilson-Bailey. I'm a financial planner. I've been doing this for over 20 years now. Today's session is just the basics of financial planning. And as we go through it, not all of it's going to be relevant to you, but there will be some parts whereby you might be thinking that applies to me, or I need to know more about that. But I'm guessing that there's going to be different people on this webinar who are at different stages. And there's something in there for everyone who's at different stages, whether you're in your 20s or whether in your 50s or 60s and you're looking at retirement. So it's just an overview, really, of financial planning. So let's get started then. Just a bit about Quilter. We have lots of links with unions. You might recognise some on there. It was sort of set up years ago by a company called Lighthouse Temple. So you might recognize that firm, but Quilter acquired Lighthouse a few years ago, and they've slowly been rebranding everything over to Quilter. So we deal with members who are looking to retire. They want a bit of information on their pension, and there's certain benefits of being part of the union, as you know, and one of those is free consultations with financial advisors. And if you do end up taking advice later on, then there's sort of discounts on fees and things. So it's well worth you being in these unions. A little bit about how we do things. So the service that we offer is fully comprehensive. Me personally, I don't do mortgages. But we do have mortgage advisors, and we have a lot of expertise. There's about 3,000 advisors now under the Quilter banner, and as you'd expect with a big FTSE 250 company, there are a lot of people that we can turn to, and Quilter's platform is huge, so we can lean on the buying power of other sort of platforms and investment funds. So that's all I'll say about that. As I said before, everyone's at a different stage. So this is a typical sort of summary of what happens as we get older. So when we're in our 20s, we've got student loans, and we've probably got less cares than what you've got when you're in your 40s. But as you get older, you'll be thinking about buying your first home, probably get married, probably start a family. Obviously, you'd need a mortgage, you'd need to save a deposit for your mortgage, and there's more on that later. As we get into our 40s, perhaps you'll climb the career ladder. Your salary tends to go up. Sometimes we get inheritances from family members who pass away. And then by the time we get into our 50s, we might be thinking about retiring. We might be thinking about inheritance tax, or what do we want to pass on when we're no longer here. And then, of course, when you're in your 60s, if you're still working, you might want to think about a phased retirement or retiring fully. So that's about bringing everything that you've built, whether that's in ISA savings or other pensions that you might have built up elsewhere with different workplaces. So that's when we should start putting things together, and working out what income that you need and where it's going to come from, and obviously in a tax efficient way. Obviously, when you're in your 70s, you're probably retired fully, and you may think about downsizing, because in your 20s and your 30s, it's all about building. And when you're older, it's about protecting what you've got for either yourself or for your beneficiaries. Now, I'll just say that, I'll just go off piece of it. If somebody told me in my 20s to put, let's say, 10% or 20% away of what your monthly income, and not be afraid to take a risk with that money either. I'm not talking about gambling. I'm talking about diversified portfolio in stocks and shares. You do very, very well. So it's never too early to start, and actually it's never too late to start to make a difference either. When we get into our 80s, we might be thinking of long-term care, our health might deteriorate. So as you can see, our income goes up and then our income starts to drop. Okay, that's just typical of a typical life cycle. The landscape that we work in is changing. Really, the way that we work has changed as well. A lot of us now work from home. Personally, I can't deal with that because I've got 2 young kids and my day's going to sort of end at like 3:30. So I prefer to be in an office most of the time. How we engage with people as well has changed. You know, people contact me on WhatsApp, text, obviously phone and email, but you know, these digital platforms become more and more relevant. Value reassessment, really, where we choose to invest our money has changed, and how we choose to invest our time has changed as well, but not so much as how we choose to invest our money. Now, there's certain funds out there that are what we call ESG, and that stands for environmental, social, and governed funds, because there are people nowadays who don't want to invest in companies like Shell or BP because they're polluting the environment with what they do. And there's some people with religious beliefs who don't want to invest in, let's say, Diageo because they distribute alcohol, or British American tobacco. So the investment portfolios have changed with people's attitudes. And obviously with Quilter, we've got funds for everyone. The world is always changing as well. So we can see here on the right that the labor market is more nomadic than it was. I've got a client who lives in the UK, but he works for an American company. So he doesn't start work till sort of 2 o'clock in the afternoon, because technology is allowing us to do this. I'm going to speak about the war in Ukraine because this has sort of changed and it's continuing to change. You must have seen recently now that Biden has authorized long-range missiles from Ukraine into Russia. The market's dropped yesterday temporarily. So that's a bit of a worry. But that happened in 2022. So when Russia rolled into the Ukraine, there was worries about energy. And so the cost of fuel went up, as you know, and everything that we get comes either on a boat or a truck. So if the cost of fuel's gone up, that means we're going to pay more, not only for petrol and diesel, we're going to pay more for everything, because the cost to get it into the shops is increased, which leads on to increased energy prices and record high inflation. There's a bit more about inflation later on, and it is a huge issue for people who are saving, because you need to beat inflation. If you're not beating inflation, if you're getting a return of 2 or 3% and inflation's at 6, it's not long before you start to see the buying power that you've got deplete. So you at least need to keep up with inflation when you're saving for either a pension or if you're just investing money. Okay, it was over 10% a few years ago, which is huge, but it has started to come down. The way to tackle inflation is to increase interest rates. So if you increase interest rates, companies can't borrow as cheaply to expand their business. And most residential properties are mortgaged, which means that will affect you as well. You've got less money to spend in the shops. The shops owners start to feel that. So what do? Then do? They lower their prices, therefore lowering inflation. So the easiest or best and quickest way to lower inflation is to make everyone feel poorer by increasing interest rates. Great for savers, but not great for borrowers. Anyway, I labored that a bit too much. Right, so by the end of this presentation, you should have a better understanding of budgeting, managing debt, and improving your credit score. If you're on the property ladder, great. There are ways that you can sort of save to get on the property ladder. There's a few sort of government incentives and things like that that you might not know about. Protecting your lifestyle is really important. You probably get things through work like death and service, like sick pay, but you've just got to plan for it. You've got to know where you are really, or you can't make a plan. So we're going to go through the basics of financial planning, the key threats, inflation. I've just covered that really, and obviously planning for the future. So you're going to know some of this probably. ISAs. I think there's a couple of questions about ISAs that came through in the last few days. So everybody can put 20,000 into an ISA, an individual savings account. It can't be joint, but you can put £20,000 from the 6th of April one year to the 5th of April the next, and you can keep doing it. Okay. Now, pension contributions have changed for the better. It used to be £40,000 is the maximum that you can put in, or now it's £60,000. So it's gone up by 50%. Now you're limited. So the maximum you can put in is 60,000 or 100% of your salary, your gross salary. So if your gross salary is 50,000 a year, you can't put 60 in. I'm going to just muddy the waters there and say to you that there's something called carry forward, where you can go back 3 years to fill in the gaps if you've not maxed out on pension contributions, but I'm not going to go through that. But as a rule of thumb, 60,000 is the maximum. You get personal savings allowances now. So anyone who's a higher rate taxpayer can earn £500 a year without having any tax on their savings, and a basic rate taxpayer can have 1,000. IHT stands for inheritance tax. You can gift £3,000 a year without it affecting your estate. CGT stands for capital gains tax. They reduced it from nearly 12,000 a few years ago. So 3,000 isn't that great, is it? But you can, let's say, for example, you can buy an expensive watch. And if you, let's say you bought it for say 10,000, if you sold it for 13, you've made a £3,000 gain. You're in your allowance. There's no capital gains tax to pay. And if you've got your own business, then there's a dividend income allowance that used to be 2,000 and now it's 500. So we've totaled that up there, 87,500. There's other things that you can do as well, like gift your children 5,000 for weddings, and there's some other things that you can do. But basically, that's your allowances for this tax year. We're just going to move on to managing your financial well-being. So if you have any money issues, it can affect your lifestyle, loss of sleep, worry, you can feel isolated, and it can impact your health. But what we say, there's a guy there with a suit on a beach. Anyway, if you don't know where you're going, if you don't know where you are, it's really hard to make a plan. Okay, have a look at your outgoings, see what you can cut. We were paying £10 a month for fridge insurance. I mean, that's ridiculous. So that's gone. You've got to review it regularly. I'd say at least once a year, but don't bury your head in the sand like this fella here. I've got an Excel spreadsheet with all of my things on, but there's other things available to you as well that are online. You can find anything online these days, but do be careful of who you listen to. So yeah, don't bury your head in the sand. Speak to your creditors if you feel like things are too hard. You can have payment holidays on mortgages and things, and you've also got Citizens Advice Bureau, etc., that can help you out, and they'll help you to make a plan if you feel like debt is getting on top of you, because it's becoming more and more apparent people getting into debt because it's so easy. It's just so easy to get into debt now. Anyway, so create a plan, spend your money wisely, list the lenders and the amount that you owe, and work out how much you can afford to sort of pay it off. If anyone's got credit card debt that's not interest free, you'd need to sort of look to pay that off first, because that's generally the highest interest that you're going to pay. Use a calendar, pay a minimum amount, just seek help from professionals. And there is a way out of these things if you're struggling, but you've just got to make a plan. Looking at things like credit score, Experian's probably the most famous one. Now, as a financial advisor, I have to do it twice a year. So every 6 months, I have to ask Experian to send me my credit report, and it gets sent off and assessed. You obviously don't have to do that usually. if you're not a financial advisor, but it's cheap. It's free to do. It used to be £2, but it's free now. You can log on to Experian and you can ask for your credit report, and they'll send it to you, and it'll take about a week or so. It'll tell you what you owe, when did you take it out, etc., what your payments are. So it is important, especially in the earlier years when you're looking to borrow, because you're going to borrow less as you get older, probably. You're going to be paying mortgages off. But it's not a bad thing to have credit and to have some debt when you're young. You're going to need a mortgage, probably. Most people can't just afford to buy a property outright. Mobile phone contracts, all of these types of things that will show up on your credit report. To help improve your credit report, obviously make payments on time, keep the credit that you've got low, the utilization low. So don't be maxing out on things like credit cards or overdrafts. If you move home, that can affect your credit score as well. But that's really all I'm going to say, because it's pretty self-explanatory there. Getting on the property ladder. Right. So lenders nowadays like to see a deposit. They like to see a big deposit. About 15 years ago, you could lend 125% of the value of your property. I think it was Northern Rock that were doing that. They called it a together loan, but that's sort of gone now. The bigger deposit that you've got, the greater choice of lenders that you're going to have, and also the lower your interest rate is likely to be, because the lenders will see you as less of a risk than someone who's got a 95% mortgage if you can afford to put down a 20%. But I know it's hard to try and save, especially if you've got student debt and other things coming out. But really try to do that. Try and put some money away every month. You won't be investing your deposit, by the way. You should keep that in the bank. Okay, because you probably want to buy a place in the next couple of years. You definitely don't want to invest where it could go up, but it could go down. You may have bank of mum and dad. They may be an option or they may not be, but just have a plan. And there's no earlier time to do it, really. Just do it. First time buyers, you can have some support from the government. I think I might just, can you see this at the bottom here? Go browse local housing services. You can just Google this, but I can't put it in the chat actually. Anyway, there are government incentives for you to benefit from it. So if you're a first time buyer, you could buy a home for 30% or 50% less than its market value. Okay, so these are these first home schemes. Just visit gov.uk. Actually, that should tell you more about that. But it is essential that you get on the property ladder. I know people who are renting in the 60s. It's like your rent's just going to keep going up. Lifetime. I'm going to talk about lifetime ISAs. So here are the rules really. Between 18 and 39, it's for you to buy your first home. Okay. You can put in no more than 4,000 a year, and you can do it until you're 50. The good thing about this is the government will give you a 25% bonus up to a maximum of 1,000 a year. There's penalties if you take it out earlier, if you don't put it towards a deposit, or if you draw it after 60. But that's a really good benefit. Go on moneyhelper.org. Just Google Money Helper and you'll find it, and that'll give you even more information, which I think is really useful. That is a relatively new thing that not a lot of people know about. Lifetime individual savings account. Shared ownership is where you share the ownership of a property from the landlord, or it's usually the housing association. You pay rent on the remaining share that you don't own, and you'd have a mortgage for the share that you do own. And later on, you can choose to buy a bigger share in the property, and at the end, you could own all of it. All right, so it's just a different way of starting out. If you can avoid it, do it the usual way. Build a big deposit or as much as you can, and you can use that as leverage to get a better rate. Okay. There's different types of mortgages. I'm not going to go through all of these. Interest only has almost died out now. If you're a landlord and you're buying a second property to rent out, you probably will have an interest only mortgage. But for everyone else, you'll have a capital repayment mortgage. Capital repayment mortgage is that every payment that you make, you're reducing the balance of it. Now, there are different types of mortgages. The most common one is the top one, fixed rate. So you fix it for 1, 2, 3, or 5 years. Standard variable rate is just what the bank will offer. So if you have a fixed rate for 2 years, that's going to end. When it does, you'll be on the standard variable rate, which means you'll probably be paying more. Capped and collared, offset, flexible tracker, discount mortgages, they're all different types. For example, a capped and collared mortgage means that your interest rate is not going to fall below, let's say, 4%, and it's not going to go as high as, let's say, 6. But they're not very popular. The most popular is a fixed rate because you just know where you are every month for the next few years. So what do you do? There's lots of mortgage advisors out there. You can go to the high street. So if you went to HSBC, they're just going to recommend an HSBC mortgage, for example. What I suggest that people do is go to an independent mortgage broker. Yeah, they work for you, not the lender, but they can deal with high street banks and they can also deal with non-high street lenders. So, for example, someone who's self-employed only for a couple of years, the high street banks might not want to deal with them, but there'll be others that will. You might pay a little bit more interest, but there are lots of mortgages out there. And if you need a recommendation, obviously you can go onto Google or you can get in touch with us and we can point you in the right direction. Protection. So we're just going to have a look at protecting your mortgage, protecting your family. These are things like life cover, critical illness cover, income protection. Everybody needs some sort of protection, but you're probably going to get something through work anyway. Because if anything happens to you or your partner and you've got a joint mortgage, yes, you might have death in service that could be paid to you, but it might not be enough to A, pay off the mortgage, and B, pay for all these other things that are not going to go. They're not going to go away. Obviously, the thing is when your partner passes away, you've not only lost your partner, but you've lost their income. Okay. And from a financial perspective, that can be devastating because your council tax is not going to go down. You know, TV license is not going to go down. There's other things that can impact it. So yeah, just ask yourself this: how would you pay your bills if you're unable to work through illness, disability, or accident? If that's the case, you might have something from work. You might have 6 months full pay, 6 months half pay, and then after 12 months, you probably don't get anything. How would your family survive financially if you were to die prematurely? If you're employed, your employer might provide a degree of protection, but it might not be enough. And if you're self-employed, you're probably not going to get much at all, unfortunately. So what are these different types of protection? So protecting debts, protecting work benefits, protecting against long-term illness, protecting against things like critical illness if you're diagnosed with something like a dread disease, these types of things. Let's talk about income protection quickly. So what this does is it's not PPI or whatever was going on a few years ago. This is full income protection and it will pay a tax-free income that's linked to your salary. All right, so usually it's no more than 50% of your net income. Okay, you can have a bit more sometimes, but it just depends. The benefits that you get from it will rise each year by inflation if you want it to. Okay, and these things are, so let's say, for example, you have an accident, or let's say that you're stressed and the doctor says that you're not fit to work. If the doctor says that you're not fit to work, then the insurance company will pay out the sum assured. Okay, so if you're normally in, let's say, 3,000 a month, it's actually 75% of your gross, not 50. So apologies for that. So the insurance company will pay out the sum assured until you either retire or until the doctor says that you're fit to go back to work. Choose a policy that pays benefit on own occupation. Right, that's a bit of jargon. But what that means is that let's say that you're a police officer and you have an accident and you can no longer do that particular job, but you could work in an office and do something totally different. That's not your own occupation. So it will still pay out. Okay. So that's really important. There's lots of ways that an employer will try and redirect you into a different role. But the income protection policy doesn't look like that. It says that, well, you're not doing that job, so it's on your own occupation. Obviously, review that when you get pay rises and things. But it's usually linked to your retirement age. So if you're 30 now and you think you're going to retire at 65, you'd have a 35-year term. Okay? And if something happens to you, let's say when you're 35 and you're not well enough to work ever again, then the insurance company will pay until you're 65. Okay, and if you index link it, it's always going to keep pace with inflation. Critical illness is something that is serious, but you don't die from. It'll pay a one-off tax-free lump sum. So usually mortgage protection can have an element of critical illness, but it's usually 2 or 3 times more expensive than just life cover because there's more chance of you having a critical illness before you die than just having an accident. Okay, now it's a payment of a lump sum. It's not linked to your ability to work. And I do know people that were diagnosed with something that was awful, but a few months later they were back to work. They won't ask for the money back. They just pay out. And we've got a panel of insurers that we can lean on. It's not linked at all to your employer benefits either. And the most common sort of protection is to protect a mortgage, because you could say it's almost worse than actually passing away for the individual, not for the family, obviously. Because if you can't work and you see that you're just racking up debt and you can't pay the mortgage off, that's devastating. So critical illness is something that we should all be thinking about, because we're all going to probably get one at some stage in our lives. Hopefully it won't be when we're young and have a young family, etc., and have debts to pay, but we never know. So financial planning, let's look at that. There's 3 different categories here. This is what Quilter have put together. So someone who's a young future thinker. So you want financial security, and what you want to do is to put money away for the longer term. You might have a mortgage. If you've got a few hundred left over, just put it away. Mid-career professional, try and make the most of what you've got before retirement. So what tends to happen is someone in the 50s might be upping their workplace pension contributions, and will be seriously thinking about retiring. And then obviously when you're retired, you want to have the lifestyle that you're used to, because you've got more time on your side. Okay, you've got your bills might go up because you're at home, but then your travel might go down. And let's be honest, most people spend more money in the 60s and 70s than what they would in their 80s, or if they make it into their 90s. Okay, so you don't want to be a miserable pensioner, and it's all about making sure that you can afford to put money away now, ready for your retirement. Life expectancy is 87 years, but there's a 7.4% chance that we're going to live to 100 years old. So what this means is that money that you save for now has to be spread a lot more thinly than what it would have done, let's say 30 years ago, because we're living longer. This is based on a 51-year-old woman, and you can look at this yourself. Go on to ONS life expectancy calculator. Just Google that, and you'll be able to see how long you've got. But the truth is, we don't know, and none of us want to know either. These are a couple of statements here. I'll just pick this last one. You can afford to retire at 65, sir, but you'll need to die at 70. All right. It's a bit depressing. I'm just going to tell you that now, though. you are going to be eligible for the state pension. All right. And people sort of think, oh, the state pension is not all that great. And to be fair, it's not going to be all that great for most people. But the state pension today, full state pension, if you're going to retire now, is £221.20 a week. Okay. So it's about 11,500 a year. And that's tax free because you've got a personal allowance of about 12 and a half. So your state pension is going to be tax free, but you need to make 35 years worth of national insurance contributions to qualify for it. If you haven't, they will tell you what you need to do to rectify it. And it's a really good idea. I don't think it's in this presentation. It's a really good idea to have a look or just Google state pension projection or even state pension age, because we're all going to retire at different ages. And it will tell you what you're going to get. It's not straight away, but they will tell you, and it's a start because you can't outlive it. It doesn't get passed on to anyone else, but you can't outlive it, and it's always going to go up with inflation. But so let's just have a look at this. Sorry, I digressed. You got 100,000. Let's say you want 100,000 in 30 years' time. If you started today, you'd need £203 going in every month. Now, what they've used here is 2% net growth, which to be honest is rubbish. If you're taking a risk and you're investing it in stocks and shares, over time, you'll get a lot more than 2% on average. But it just gives you an indication that probably if you're putting this money in the bank, this is what you're going to get, because cash is still not very good. If you waited a year, you'd have to put 213. And if you didn't do anything for 10 years, you'd have to put in 339. So it just goes to show, as I keep banking on about, just do something now. And it can become addictive actually. When you see things go up and when you see that, you're building, you're like, oh, let's put some more in, let's put some more in. Anyway, but if you don't make a start, you're never going to get that. Financial security, freedom, flexibility, it gives you all of these things. Some people tell me that I had a meeting with a client yesterday. She's like, I don't want to go and live with my daughter. I want to go into a care home. I was like, why? She said, well, because they've got their own family and I don't want to be a burden. And to be fair, she can afford a care home anyway. But there's all these different things that you need to think about. You're retired nowadays for a lot longer than what you were 30 years ago, so it's even more relevant.
That was a bit much, wasn't it?
Sorry about the background noise there. So where will your income come from? Wherever you build up now is going to help you in the future. I've just mentioned the state pension. I'm 47, so I'm not going to get the state pension until I'm 68. Okay, if you're in your 50s, you're probably looking at 67. Right, so you've got the state pension, workplace pension. You might have lots of workplace pensions that you built up and you might have forgotten about them or you just don't want to deal with them. You need to get the policy numbers and speak to a financial advisor. And what they will do is they'll write off to all these different pension providers. We do it for free, actually. We just need your policy number. You need to sign a form. We can't change or do anything. The only thing we can do is ask questions. So you can pull all of these workplace pensions together. Even if you're not near retirement age, you should still think about doing that exercise. Private pensions are things that you built up on your own, but your personal pension and a workplace pension are basically the same thing. It's just that with a workplace pension, you're in a group and it might be a little bit cheaper. Okay, but that's how it is. If you've got a final salary pension, then they're a bit more expensive to pay into. But the income that you get versus the others is guaranteed. It's always going to go up with inflation. And let's be honest, the final salary pension is going to be the better scheme, especially if you've been in it for a long time. Other things that you can have that can help you later on in life: savings and investments, ISAs, cash ISAs for short term. Great. So if you want to save for a deposit for your first house, one of the things that you can do is you can put it in a cash ISA. Just search around money supermarket, see who's paying the highest rate. It's never going to go down. You're never going to lose any of your money, and it's always going to go up. Okay, so that's what you should be doing for short-term emergency monies. If you've got a big holiday planned in 2 years' time, or if you need to change your car, don't be investing that. Leave it in the bank because you need to draw on it. Okay, now you can have investment ISAs, but they're for more long term, and they go up and they go down. If you take a huge risk, which you can, if you can have it all in stocks and shares, and you're making regular payments, and if you're in your 20s, 30s, even if you're in your 40s, don't be afraid of that. Okay, just make sure that your advisor's got your attitude to risk right, and you've got lots and lots of diversity. Obviously, you've got your own property, which you could sell and downsize. You might have a second property. You might inherit a property. These are all things that you can put into the pot that can help you to get the income that you need when you retire. Financial support, I suppose these are things from bank of mum and dad again, or perhaps inheritances. But really, it's down to us as individuals to make a plan. Tax, you can't get away from tax, really. And it's a bit of a con, especially VAT. But anyway, we won't go into that. Your pension is taxed as if you've earned it. Okay, you don't pay national insurance on your pension income, but you do pay income tax. But that can be minimized. You can have access to tax-free cash, which you could invest. And if you invest it properly, eventually it'll be tax-free because you just drip feed it into ISAs every year. But I'm not going to go into that today. But you will have to pay tax on your retirement income, which is based on your tax, your tax rate now. So if you're a high rate taxpayer, when you retire, you'll pay 40% on your retirement income, only on 75% of your pension pot. Okay, because the first 25% of it is tax-free. Let's say, for example, that you want £1,000 a month out of a group personal pension or a private pension, something like that. In that case, you can have your tax-free cash paid to you on the drip if you want. So £1,000 a month, the first 250 is tax-free. You're only paying tax on 750. Okay, so there's ways that you can plan and structure things so you pay less tax when you retire. How much can I take? Okay, well, you just have a chat with your advisor, really. I mean, if you've got a private pension with 100,000 in it and you want it all out, which you can if your provider will offer you that flexible access, you're going to pay so much tax and you're not going to get it back. You know, I had that question last week. I was like, no, it's ridiculous. You don't do that. And obviously, when you're taking money out of your pension, just take out what you need. I have clients who take out more than what they need, say they're going to spend it, they don't spend it. And I'm like, well, why are you taking money out of something that's incredibly tax efficient, that is growing a lot more than your bank account, yet you're keeping it in your bank account? Spend it. It's more fun. In the end, it's more fun than saving it as well. But anyway, as you know, tax changes all the time, especially this last budget, which was a bit sneaky. Anyway, we won't get into that either. Inflation, we've touched on this before. So over time, it's like a tax when you think about it. The cost of goods and services usually goes up over the long term, and it's expressed as a percentage. The goal is 2.5%, and we're nearly at that. So this is why the Bank of England dropped it last month by 0.25. Whatever happens in the US tends to happen over here. We think there might be another rate cut this year because the Governor Bailey has said they're going to cut aggressively. That was the comment. So perhaps they're going to have another rate cut in December because it looks like we've got inflation under control, certainly for the moment. But all it means is that, I mean, if you think back to what your first car cost or what your first home cost all those years ago and think what you're going to pay for it now. Like, for example, a Ford Fiesta in the 70s cost about £1,900. Now it's like 18,000. It's essentially the same car. Okay, so you've got to make sure that the monies that you're saving that for long term are going to beat inflation, or it's not going to work. And you do have to take some risk with that. It doesn't have to be high risk, but be low risk, but you've still got to bear in mind that you need to beat inflation. I'm aware of time here, because this is what happens. This is what happened with inflation over the last few years. We can see in 2022, when Russia rolled into the Ukraine, it was at its highest over 10%. Now, as a pensioner, you got a 10% pay rise on your state pension, which cost a fortune. But there you go, you got it because of this triple lock that they've got. And now we can see it's slowly coming down. What we want it to be is around about this 2.5 bit here. You probably can't see my cursor, but that's what it should be. We don't want disinflation either, by the way. But this is the consumer prices index, and we can see that it is starting to come under control, which is why we might see interest rates drop. If you had £10,000, don't know what's happened there with this. Anyway, you can see the effect of inflation and what it has over the longer term. Because your £10,000 in 20 years' time is not going to buy you what it can buy you today. And here's another graph about inflation. So this is cash ISA. This is the grey line here. Rates are starting to go up to curb inflation, but it's never as high. So if all you're doing is investing in a cash ISA, your money is not going to keep up and it's going to rot away. Okay, so you just got to be aware than that. So if you put £10,000 in a global equity fund, so that's all stocks and shares all over the world, over 30 years, it'd be worth 110,000. You've got to see this thing at the bottom though. You may get back less than you invested, because if you put, let's say you put some money in on the 1st of January and you want it out on the 1st of December the same year, you might not get back what you've invested. You might not. You've got to do it for the long term, and that's obviously something that we're quite skilled in and we can help with. Say, talk to an advisor. So hopefully you've got a better understanding of the basics. Really, this is quite a basic seminar. Getting on the property ladder as soon as you can is a good idea, and the avoidable threat to your planning, actually, first thing is not making a plan at all, having an unrealistic plan, and keeping all of your wealth in the bank. It's just not going to work for you. So speak to an advisor if you think you need to. You can have meetings for free with us. I have 2 or 3 meetings with clients before they understand or before they're ready to go ahead. It's fine. There's never cost for meetings. There's always an investment that the advisor makes in time to find out where the client is and what they need, because you can't plan any other way. You've got to do a proper fact find out about your client, when they want to retire in today's money, what do they want to retire on, and then we look at what they've got and make suggestions or make a recommendation. Okay, diversify your investments, build a plan, don't be afraid of risk. The other thing is any private pensions that you've that you've built up. Let's say that you're 60 now and you want to retire at 65. It doesn't make sense to put all of that in cash to protect yourself, because the chances are you want to draw on what you've built up flexibly. Like that example I gave a couple of minutes ago. You know, you want £1,000 a month. Well, let's take that out of your pension. And if you do take that out of your pension and it grows at, let's say, 6%, well, it looks like you're treading water and it's never going to go down. Obviously, it depends what you've got and it depends on your attitude to risk. Just take advice. People think advice is expensive. It's not really. You can walk away at any time if you decide that you don't want to take it any further and you don't want a recommendation. So I just urge you just to speak to someone and have a chat and just find out where you are and look at your objectives and have a realistic, like I'm pretty, I wouldn't say brutal, but you know, if your money's going to run out at 70, that might be an issue. If your money's going to run out at 110, and we can project this, by the way, then that's all right, obviously. Optimize it, just review everything regularly, and you might need an advisor to help you, but you might not. But just bear that in mind. Tax is also a thing, and obviously your advisor is liable for the advice and to make sure that you are maximizing all of your tax benefits that we've just described a couple of slides ago. I don't understand that graph, if I'm honest with you, so I'm not going to go there. So we offer a free consultation. I normally spend an hour. I block an hour out. If it goes over, that's fine. Sometimes people don't need an hour. Sometimes people just want to ask a question and it might take 5 minutes, and that's fine. Some people want to say, right, well, I'm okay, but my husband is, or my wife is got a pension elsewhere. Can you help with that? Well, we can. So anyone who's the partner of a union member, they would get the same discount, the same sort of service as what you would, because we extend it to family members. And we'd normally have a chat over the phone. We can do a Teams meeting, or if you're quite close by, one of the advisors can come out to see you as well. But usually we just have a chat over the phone first and just look at what you've got. You need to grab all your paperwork, your last pension statement, a list of your savings and investments, and things like that. And then you'll have a really productive meeting. And many times I just say to people, well, it looks like you'll be all right, but what you perhaps need to do is just change this, and maybe you could move that over there, and it might be just something that someone can do themselves without paying for a recommendation. If you're going to move pensions from one to another, then you'd need an advisor to do that anyway, usually. So there would be fees involved in that. But if you don't want to do it and you don't want to pay the fee, then you don't go that far. But there's usually a good reason for you to move it from A to B. And the fee is irrelevant, really, because it's going to give you what you want. And yeah, I've touched on this really, but this is how it works. Okay, so the first bit is probably the longest bit. So understanding where you are now, what have you built up? Where is it? How much if you've got an investment elsewhere, it might not be doing very well. If you've got a pension elsewhere that you've not looked at for a number of years, it might not be in the best fund. You might be charged heavily since leaving the scheme. And the pension providers are not authorized to tell you this. They can't, because it could be construed as advice. Like they're never going to write to you and say, did you know that you're in cash and it's not growing? We think that you should move it over into this fund. They're not authorized to give you that advice. It's only an advisor that can do that. So it's about we do it. We write to all the companies that you might be with, and we'd get a snapshot they fill out a questionnaire basically. And then we look to see what the advantages and disadvantages are of where you are. But part of that, the other important thing is looking at, right, when do you want to retire? How much do you want to live on? Realistically, if you're going to retire today, how much do you want? And we sort of future-proof it with indexation. And a lot of the time, people are going to get what they need, but sometimes they're not, because they might want to retire early. Deal with lots of teachers and doctors and nurses who just say, there's no way I can carry on doing this job when I'm 67. No way can I work at 100 miles an hour. And if you think like that, then you perhaps need to have a chat with an advisor, because what they'll then do is they'll put a plan together a bit later on. Actually, they'll put a plan together and they'll implement the advice. So they'll do all the admin. All you've got to do is sign a few bits and pieces. You get a 30-page report to back up the advice. How much you're being charged where you were, how much your charge is now, what has the performance been like with this other pension, what has it been like with the new one, all of those types of things. So once we've implemented the advice, we then like to come out back and see you every year. If you want that service, you don't have to have it. But as things change, we refine it. So in your younger years, don't be afraid of risk. Volatility is not a bad thing. When the markets go down, let's say you're saving into a personal pension or an investment ISA, the markets have gone down and you're in your 30s, you should rub your hands together and think, I'm going to get this now at a discount if I buy some more. That's how it works. But it doesn't feel right, because we're all told as kids, there's no such thing as a free lunch. Don't throw good money after bad. It doesn't really work like that. I've seen a client last week. He made like 20, he's a high risk taker. He made like nearly 20%, not even in 12 months. The markets have done well. I can't take all the credit for it. So it's different for everyone. But just make a start. And if you want to have a chat with an advisor, there is this QR code. So you can take a picture of this with your phone. It will take you to a landing page. We'll ask for your name, your postcode, and what do you want to talk about, basically. And one of us, it might be me, it might be one of my colleagues, will give you a call back and have a chat with you over the phone. Doesn't cost anything, but I think it's well worthwhile you doing it, especially if you're in your 50s, perhaps your 60s, and you're thinking of which options do I take with my pension? Do I take higher tax-free cash if I've got a final salary scheme? Do I take the higher income? There's all these different considerations, and let's be honest, there's so much jargon with pensions now. It's just mad. You've got 2 or 3 names for the same thing half the time. And obviously we can help you. We can help you through all of that. And even if it's just, can you just go through this form with me? We can do it. I mean, I do it for people because they might need your advice later on. So that's the way I work. Right. So we said that this would last about 45 minutes. I've gone over, but I've got 5 minutes left. If anybody wants to ask any questions, there is a tab, a Q&A tab at the top. So are there any questions? Doesn't look like it. Oh, you got any questions, Ashia? Oh, someone's put their hand up. Don't know who it is.
I say no questions from me, but if you're struggling with the Q&A tab, then just leave your questions in the chat. That's easier.
Yeah, they can do that.
Yeah. Because I cannot activate your microphones, unfortunately. Oh.
Right.
Yeah.
Okay, there's someone with their hand up though.
I can see. What was this for? For Queen Cole, I'll activate your microphone for a second if you have a question. Can I? Oh, will you send? Yes, I will send everyone the recording. So directly after this, I'll send everyone the recording and also the link to this form as well if you haven't been able to sign up. Awesome. Any other questions? Oh, there you go. Do you see the question in the chat, Darren?
In the Q&A chat.
No, in
oh
just
yes.
yeah.
Will you please send us the recording? Yeah, that's what I've got.
Oh no, there's another one here. Can you withdraw money from a pension to buy a house to add to a deposit?
Yeah, where is that question? Okay,
It's in
I
the
can't
chat.
see that question. It's in the chat.
Meeting chat, not in the Q&A. Yeah.
Yeah. Can you? Evelyn said that. Can you draw money from a pension to buy a house to add to a deposit? Yes, you can, but you've got to be careful how you do it because there's tax implications. Yeah, you can. If you've got a private pension, then you can. If you're over the age of 55 now, you can start to draw on your private pension. If you've got a pension that's a final salary scheme, then you can, but you probably shouldn't because you'll be charged penalties. It's called an actuarial adjustment because if you take money out of it, you've got to take the income as well. You can't just take the lump sum out of your final salary pension and not take the income. Obviously, you're taxed on the income, but if you've got a private pension and you're over 55 now, you can take up to 25% tax free. And you can take it all out if you want to, but you'll be taxed as if you've earned it. So you might decide in the end that that's not a good idea. But everyone's situation is different. To be honest, we need to know a lot more about what you're looking to do. So we can have another chat privately. if that's what you want. There's someone else with their hand up. I think it's Queen Cole. Maybe not.
I think that's still from before.
Oh, Evelyn, so you cannot withdraw from a government one. You can. If you're over 55, Evelyn, you can. You can draw your tax-free cash, but you'd have to draw the income as well. You can't just take the cash and leave the income. And there's other implications depending on what type of government scheme that you're in. So if you're in one that where your normal retirement age is 65 and you're 55 now, if you take that now, let's say you've got two pensions. I don't want to get into too much detail. It's not a good idea, but it depends how old you are. You'd be effectively taking your pension early. So let's say, for example, you're not supposed to take it until you're 65 and you're 55 now, but you want to get to it. That's 10 years actuarial adjustment. So you're going to lose 50% of your built up benefits. Not quite that, but as a rule of thumb, it's 5% a year. So if you're 63 and you're not supposed to retire at 65, that's far more palatable because that's only a 2-year actuarial adjustment. And they can tell you, you can ask for a retirement pack. You don't have to ask, you don't have to act on it, but they can tell you what you get. And depending on which scheme that you're in, you can log on and you've got these sliders sometimes if you're in the local government pension scheme, and it'll tell you what you're going to get at what age that you want to retire. But generally, it's not a good idea to tinker with your pensions in your 50s and start to take them. I know you pay a lot into government pension schemes. I know you see it on your salary. You say, well, this, oh God, that's a lot. It's a lot that goes out. But what you don't see is your employer contribution. So your employer contribution could be double what you're paying in. And it's index linked. And even if you leave and go and work in the private sector and you have a private pension, you know, you're building up no more years service. There's no more money going into it because it's deferred. But what happens is the salary that you left on would go up with inflation every year. And obviously, if you go and work in the private sector, then they're obliged to offer you a pension scheme as well. But it won't be as good as the one you're in. And I deal with private pensions, but I'm going to tell you straight, income wise, you're better off in your government pension. If you get a big lump sum, I mean, the other question that we get is, as people retire, they say, right, well, I've got two options. I can take standard benefits, where I'm going to get this amount of income and this amount of tax-free cash, or I can commute some of my income and get a higher tax-free cash. And usually it's like a lot more, and your income doesn't go down as much as what you think. So we get that question a lot. And it just depends on what your situation is. What else have you built up? Does your partner have a pension? Do you look at your finances jointly? There's so many things. I just can't answer that. But if you want to get in touch, Evelyn, then I'm very happy to spend some time with you and just answer some of your questions. But generally speaking, you should try and leave your government pension as long as you possibly can. And I know it's changed since 2015. You've had McLeod and you've had this new care scheme. It's not as good as your older scheme, but unfortunately, people are living longer, and it's just a cost-saving exercise, which means that for us, we have to work longer to get the same, if not reduced benefits. So, yeah, just get in touch, and we can go through it. No problem. What's the best way to do it? Marie, thank you. I don't know what that means.
I think she's referring to withdrawing from your pension to buy a house.
Oh, I thought that Evelyn had said that. Okay, well, if that's a question on the back of Evelyn's question, I don't know the best way to do it. It depends what you've got. What you don't want is take massive chunks out of your pension because you'll be taxed as if you've earned it. The best thing to do is to any money that's in cash that's not earning much, then take it out of there. Take it out of the least tax efficient and the least investment that you've got for growth, and that's usually cash. But yeah, just get back in touch with us and we'll have a chat about that as well.
There's another question there as well from Marie. Are there any savings accounts that you would recommend? And then as a side note, she said that offer prizes.
Offer prizes. The only thing that I can say to you, prize-wise, is NS&I premium bonds. You can pay 50 grand in it. The interest rate's not that good. For every month, you have a draw. They have a draw. I know plenty of people who get 20 quid, 50 quid, 100 quid. I've never met a millionaire because that's the top price. You can get £1 million. So it's like it's not a gamble because it never goes down. And don't forget, NS&I is owned by the government. So it's never going to go out of business. But the most you can put in to premium bonds is 50,000. But over time, you'll do better by investing it. And we've got quite a good way to look at what your propensity is to take risk. So you might be medium risk, you might be high risk or cautious, but that will grow more than anything. You've just got to understand it really, because it can go down like 20-30% if you're taking a high risk. But if you understand that there's nothing wrong with the stock market, it's just at that point people don't want to take the risk, like in 2008, like in 9/11, like during COVID. Like during COVID was such a weird time because I remember looking at the FTSE, it was 4,500 at the time, the ticker tape at the bottom of the news. I was addicted to the news during COVID in 2020. And I remember saying to my wife, right, this is what I tell my clients to do. Let's take some cash and let's put it now. Let's do it now. And I backed out. And the reason why I didn't do it is because I thought, I don't know when I'm going to go back to work. So I might need my cash. Because I don't know. I wasn't seeing clients. We were doing teams and it's not the same and blah, 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 blah. But then it went up like so much more than it went down. Because it was really easy in a way, if you're a fund manager, to know what to avoid during COVID. So if you're a stock picker and you're managing people's money, you're not going to be buying airline stocks. You're not going to be buying retail. In fact, you're not going to be buying anything that's down to enjoying yourself because we were all locked down. But then a few months later, it became apparent what you could buy. For example, Microsoft did really well because they had Microsoft Teams. It took off. Everyone was Zooming. So there were certain things that were pretty undervalued at that time and people did well on it. But yeah, it was a weird situation. Don't panic when that type of thing happens. Put more money into it. There's nothing wrong with it. Like if you've invested in one stock, let's say you've invested all of your money in Marks and Spencers. I mean, that's ridiculous. That's like going to the races because they could go out of business and you've lost all your money. But if you've got a diversified portfolio, you're a shareholder of hundreds or even thousands of companies sometimes all over the world, different sectors, IT, healthcare, banking, mining, all of these other things. If you've got a mixed bag of investments, that is the way to go because that automatically lowers your risk. But the more that you've got in stocks and shares, the more volatile it's going to be. Okay, but history has definitely taught us that you will do better doing that if you can stomach the downs than just leaving it in cash for 30 years. It's like so much evidence. I mean, you can all Google it, and you'll know you'll see that. It's just that sometimes it goes down a lot and people panic, and guess who's going to buy that stock off you? The people who understand it, who want a deal. Keep it, buy more. But you might need an advisor to guide you through it if you're not comfortable doing it on your own. But generally, that's the way it works. Because if it didn't work that way, it wouldn't exist, would it? There wouldn't be a stock market. Everything would just be private and there'd be nothing floating on the stock market. So it does work, but only over time. Don't try and play it. Don't try and pick the bottom or pick the top. And we're trading at all-time highs these last few weeks. Temptation for some people is to stick it in cash. but it was trading at all-time highs a few months ago as well, and it just still keeps going up. So I can't predict. No one, if anyone says that they know, just run a mile. And crypto and all of that, it's just too volatile, really. I know people who've done well, people who've lost their shirt. That's not what we do. You know, we buy and hold. We've got investment experts, and with Quilter, you know, we're huge, so we can drive down the costs. There's something for everyone. And if you're one of these people who doesn't want to invest in Shell or anything like that, and if you're environmentally aware, then we've got portfolios for those types of people as well. Some people don't care so long as it makes money, but others do care where they put their money. They want to. One of the questions in the risk profile is, I feel inspired to know that my investment portfolio is having a positive impact on the environment. Like, it's these types of questions that we ask. Yeah, so that's part of the process, really. Yeah, I hope I've answered that. I've gone way over, by the way, but and I see people dropping out. But I can answer more questions if you like. I don't have another meeting till 2. So, are there any other questions?
I don't.
No.
I don't see any.
There's someone with their hand up. Don't know who that is.
That's Queen Cole.
Maybe.
Do you have a question?
Oh, I think they might just be left up.
Yeah.
Yeah. Okay.
Oh, here's Marie.
Okay.
Is it worth putting money into an S&I if you don't have a lot of money?
Yeah, if you're risk averse and you don't have a lot of money. But what I would say is, I don't know what you mean by a lot of money. If you've got, say, 20,000, yeah, and an NS&I, probably. You might become a winner. You never know. But what I would do first, I would just Google best savings rates, and there'll be loads of comparison sites, and you'll be able to see them. And you're going to get more if you tie it up for a year or 2 than if you just have instant access, because they know they've got your money for that long. So generally, you'll get a better rate of interest if you tie it up for longer. And I think if you did it now, I think there's going to be another. I'm not a fortune teller, and I might be wrong, by the way, but I think they're going to cut again in December, which is not good news for savers, but good news for borrowers. So yeah, there are lots of things to do. Obviously, NS&I, as I've said, is backed by the government, so they're never going to go out of business. And you never know, whatever you put in there, you might get called and you might be a millionaire. You might, and people love that. I know, like all of my clients who are, let's say, wealthy, they've got over, let's say, 500 grand in like liquid assets. Bet your bottom dollar some have got in premium bonds. Yeah, because people like them. But interest rate wise, it's not great. You're going to be better off. And if you're looking for the longer term, you're better off investing. And you can start with nothing and just pay in every month. And that's something called pound cost averaging.
You've got another question there. What is an NS&I?
National Savings and Investments. It's a government run sort of, it's not a bank or a building society. It's just savings that you can go into. So yeah, NS&I, National Savings and Investments. And the most popular one is premium bonds, in my opinion, because lots of my clients have got them. But they've got them on the side of investments. They've got them as an emergency fund. Like, I've got one client's got 50 grand, but he sees it as an emergency fund in NS&I, and he's invested the rest because he can get to it whenever he wants. See, you're not tied up. And any monies that you invest, by the way, for the long term, you're not tied up either. You can take your money out whenever you want. You're not, no penalties. You don't know what you're going to get back from 1 year to the next. But you can get to your money whenever you want. And it's the same with cash deposits. If you've not tied it up for a year or two, you can get to your money. So yeah, NS&I, if you're totally risk averse and you don't want any risk whatsoever, they're quite popular with that type of person. Doesn't everybody wants to take the risk, you know? That's the way it is. But everyone should consider it, in my opinion. You should consider everything and then discount it. You should at least know what you can do. You know, and if you are looking to invest, you move your pensions or whatever, go through a thorough risk assessment where you get definitions of a balanced investor, if that's how you answered it. And I'd even give you examples of how it's performed in the past, with the caveat that I'm not a fortune teller and I can't predict that it's always going to do what it's done. Okay. Just think the more risk you take, the more volatile it's going to be. But over a 20-year period, you're probably going to make more money than if you were cautious. And there's evidence to back that up. That's not me saying that. That's not what I think. That there are evidence. There's evidence out there. But you've just got to, you might need a bit of help. Someone's Green Coal got a hand up again, maybe. I hope I've answered that. Have I answered that last question, Marie?
You do have one more question as well now in the Q&A. What will be the best savings for 50,000 for a longer period?
Can't tell you that really, because everyone's different. If you've got 50,000, and if you think the long term, let's say it's 10 years plus, then
That's
the
absolutely
first thing that
open the door.
is using your ISA allowance. So if you have a partner, you can both invest 20,000 into an investment ISA or a cash ISA, but that's at the mercy of inflation. But if you invested it into an investment ISA, you could do 40,000 now, and then after the 6th of April, if you've got 10 left, you can add it to your ISA at the start of the new tax year. Or you can invest the whole 50,000, both have an ISA each. So 40,000, and then the 10 that's left over goes into what we call a general investment account, which is exactly the same portfolio. It just can't have an ISA wrapper around it until next tax year. If you don't have a partner, then you invest the whole 50,000. You have 20,000 in an investment ISA, and then 30 in a general investment account, or GIA we'll call it. Same portfolio, just not as tax efficient. And then every year we are moving 20,000 from the GIA into your ISA. So over the course of about 18 months, 2 years, all of that 50 grand is tax free whenever you want an income or whenever you want a lump sum. So that's sort of what we do. But if you don't want any risk, then I just can't say. I'm not au fait with interest rates and different banks and building societies. It changes a lot. It's not my area, so I would just ask you to Google it. But yeah, premium bonds is not a bad thing if you're totally risk averse. But it's not going to grow as much as if you took an investment. But you've got to have time on your side for that. Is that okay?
Yeah, that's
Do we have any
great.
more?
I don't see any more. Any other questions for Darren? And also don't forget, if you have something that's more personal that you want to ask, just scan that QR code and you'll be able to really go into depth for that hour.
Yeah. Yeah, yeah. And even if we have to meet up later on, like if we use the first hour and then we say, actually, well, we haven't tackled everything we need, we just book another appointment. There's no costs.
There you go.
There's no cost until until you decide to take advice. You might not need advice. You might need a bit of guidance. But if you want us to move pensions from one to the other, that just takes a little bit of a while. And there are costs involved. But you'd know how much it costs before you decide to go ahead. But there's got to be a good reason for you to move it over. Anyway, you can't just make something up. It's got to put you in a better position because we have to evidence it. Like a lot of these reports that we write, clients present it to clients, but there's that much jargon in it now because the FCA and they're so worried about complaints and things. It's a bit of a nightmare. But we go through the reports. Why are you doing what you're doing? Why are you investing money? Why are you moving money from this pension to that pension? What is the reason? How much are you paying for it? Is it a self-defeating object? Are the costs, do they outweigh the benefits? Well, then we don't do it. Because even if the client doesn't fully understand what goes on in that report, when the FCA do their visit, they will understand. So they want to see that, the advice that we've given is appropriate, risk is appropriate, and we are definitely putting the client in a better position than where they are now because it's evidenced in the report. But they become more and more long-winded over the years. I've been doing this for over 20 years, and reports were sometimes like 5 or 6 pages long. Now they're up to 30 pages long. Okay, but we break it down. We explain it to you in English. We say, well, this is what that means. This is what that means. This is the costs. If it's more expensive than where you are, well, what are the benefits of that? How much is the cost extra in percentage and pounds and pence? But at that point, before you say, yes, go ahead, I want to do it, you'll know everything that you need to know. And the report is just backs it all up. So you've got something there to back up the advice. And obviously, Quilter are huge. So the FCA call it impact. Okay, so the impact that we could have if we sort of don't do what we should do, it's big, which is why things like pension transfers, we've got a checker checking me, and then there's a checker checking the checker. So it takes like over a month to get it all done. And it's just the compliance. But at the end of the day, I don't disagree with it because it's all there for your protection. And that's never a bad thing. So yes, there's more hoops to jump through. Cost of compliance has gone up. But at the end of the day, I think that the consumer now has a far, far better service and solution than what they would have done even 10 years ago. Like I've worked offshore, believe it or not, as a financial advisor in my 20s. And there's no regulation offshore. Not like here. But it's compliance is a good thing. So Quilter are huge. So we have to do probably more than your normal IFA down the road because they're not on the radar and the impact is lower. So yeah, we're a bit long-winded, but you'll get what you want, hopefully.
That's awesome.
Yeah.
But, thank you, Darren.
Is that all right?
Yeah, I think that's everything. I don't think anyone has any more questions.
Got 11 people left. I'm amazed.
I
thought I'd have no one.
Yeah.
Pensions is.
Yes, I'm wondering,
sometimes
do you guys
it's so
still
dry.
have any more questions? Because, I mean, as you said, Darren's here if you need him. But I don't think so. They've had their time, no.
Yeah, I think they're all.
Yeah, just listening.
Bored
Amazing.
of me now. Fair enough.
No. But I will follow up with the email, everyone, so you guys can rewatch this and, as I said, sign up with Quilter. And yeah, Darren, thank you very much.
You're welcome. All right.
Yeah.
Have a nice day, guys.
Yeah, you too.
See you.
Bye,
Bye-bye.
everyone. Bye.